Welcome back. You're watching Buy Now, Sell Now, and it's time to get connected with another management. And we are talking about Suryoday SFB. Strong Q4 reported. Asset quality has improved quarter-on-quarter basis. Provision remains flat though, but a sharp improvement in operating profit. Now Suryoday SFB will be focusing on new branches and loan growth, which is stabilized. Spreads and NII also look healthy. But then let's get in more details. We are joined by Mr. R. Bhaskar Babu, MD CEO Suryoday Small Finance Bank. Hi there, good morning and welcome to the show. All right, so very first question, you've reported strong growth this quarter. What were the key drivers behind this growth and how sustainable is this momentum going into FY27?
Yeah, we had a good quarter in the year in terms of both growth in terms of disbursements as well as sharp reduction in terms of slippages. Overall, microfinance industry had put in guardrails, and across the industry, there has been a sharp improvement in terms of collections. So there has been tailwinds for sure, but we moved away from JLG model to individual loans. And the traction there has been far more stronger than probably the JLG segment. So combination of that and the growth in other retail assets like commercial vehicle, LAP, all put together really worked out. The foundations laid a couple of quarters back are playing out and fairly confident that this will sustain.
Mr. Babu, hi, this is Ankita also joining in. Your operating profit and PAT have also improved sharply on lower provisions and better operating leverage. How much of this improvement is structural versus cyclical?
Broadly, I think it is structural. A couple of quarters in terms of the guardrails that has been poured, in terms of our own strengthened underwriting, and more importantly, a couple of digital products have picked up very well traction. Both digital fixed deposit today constitutes around closer to 50% of our incremental deposit, and acquisition cost for that is substantially lower than through the traditional branch model. While the both models will exist in terms of branches being trust points, the transaction points are substantially moved towards, including acquiring, has gone to digital. And we have introduced credit on UPI, which is finding traction. So on both sides of the traditional products and the digital products combinedly working out with a substantial reduction in slippages have contributed to it. And I would think that it's structural rather than cyclical.
Let's talk about NIMs. NIMs have improved 7.9% with lower cost of funds. Now, how much more room is left for margin expansion over here? And also, how do you see NIMs evolving as the portfolio becomes more secure and competitive?
We're fairly in a sweet spot of 45% in terms of unsecured and 55% in terms of non-unsecured, which includes a little bit of a lending to the NBFCs. Put together fairly good mix. This is what we wanted to achieve for a period of time. We'll stay here at this combination, which will ensure that our NIMs may not shoot up substantially, but it will be in the range of around 8-8.5% for the year.
Right, Mr. Babu, also the GNPA and the NNPA improving and the recoveries are expected under the CGMFU scheme. How should the investors look at the credit costs and the return ratio in FY27?
The credit costs will be closer to around 100 basis points. And we are substantially benefited by taking a cover under CGFMU long back when observability was benign and the expected credit loss are not more than 1%. But we did do this as a measure of risk management rather than in terms of claiming more than the premium which we paid. Because as you know, that the industry goes through cycles sometimes once in 3 years, maybe even once in 5 years. But whenever it happens, we wanted to be making sure that we are fortifying our balance sheet. So given that we are continuing to cover CGFMU, even likely that our claims will be lower than the premium in the next couple of years. So adjusted for that, it's no more than 100 basis points is what we are planning for this year.
Now, despite industry-wide competition for deposits, you seem to have improved the retail deposit mix and reduced cost of funds. What strategies over here are working for you?
So we're still at around 7.5, 7.6 in terms of cost of deposits, which is not really low. But we are rolling over certain high-cost deposits which are taken in the past. But we have moved to completely granular, so not dependent on any large bulk deposit, which is substantially rate sensitive. As the rates are moved up in the bulk, the retail is still holding, while the competition has substantially increased, making it CASA far more difficult than it was in the past. But overall mix, we are fairly confident that we'll maintain the cost of deposits, even in a scenario like this where there is tight competition for deposits and the rates haven't cooled, whatever we saw even in March. So there may not be a big improvement, but we are fairly confident of holding the line at this point of time.
Mr. Babu, the digital lending UPI credit line is expected to double. What is its current share of the book, and how is the asset quality behaving in this segment? And how do you manage the risk in the high-frequency digital lending space?
This is more in terms of a charge card product where customer utilizes the average limit that we give is around less than 10,000. But the number of it's a completely customer acquiring engine. We acquire customers for giving a credit as low as around less than 10. And you get to know the credit quality exactly at the end of the month itself. There is a payment which has to be made on the common due date, which is the 3rd or 4th, with a grace period. As of now, it is holding up, but the portfolio overall is very less as compared to around 10, just 100 to 200 crores, 200 crores as we speak. We may not see a big spike in that EVM, but what you're likely to see is a large customer acquiring. Currently, we have 5 lakh customers we utilize, likely that it will at least be double, if not more, during the year. We are very, very conscious about it. We are increasing that for AUM size, but we will use it as a big customer acquiring engine.
All right, FY27 targets look aggressive now. 30-35% growth, ROE 13 to 14%, GNPA 3%. Now, what are the key assumptions behind these targets, and which levers give you confidence in achieving them?
Yeah, we didn't burn the candles last quarter, so fairly confident that we'll sustain that in Q1 and take it forward to Q2. The learnings of the past is in terms of sustainability and consistency is far more important than higher ROE at one spike. So we'll take it up to around closer to around 13-14%. And intent is to really keep moving up the ROE by 50 basis points, 100 basis points year on year. The growth has to be seen in the context that our base is low, just about around 13,000 crores in terms of asset size. So this is on a smaller base. And if we repeat what we have been doing for the last 2 quarters without even increasing disbursement substantially, we are likely to see a growth in the EVM. That gives us a reasonable confidence.
All right. Thank you so much for joining us. We'll let you go on that note, Mr. Babu. Thank you so much for taking the time out. Let's move on then.
Thanks.
And